Okay, let's dive right into this explainer. We're going to unpack the sheer mind-boggling scale of the US stock market today and look exactly at how insanely top-heavy it's become, all thanks to the massive boom in artificial intelligence. Look, if you have a retirement account, a brokerage account, or really just a passing interest in where the global economy is heading right now, this structural shift is going to fundamentally change how you look at diversification. Seriously, it's a game changer.
So, here's our agenda for today. We've got 1. Global stock market dominance. 2. The great narrowing. 3. The AI heavyweights. 4. The valuation disconnect. And finally, 5. Risks and investor strategies. Let's get to it.
Section 1, Global Stock Market Dominance. Just look at this number for a second. As of 2026, the total market cap of all domestic companies listed in the US crossed this absolutely incredible $77.9 trillion mark. Honestly, it's a number so huge it almost loses its meaning, right? That is, until you stack it up against the rest of the planet. The US accounts for roughly half of the entire world's total stock market value. Half! It vastly overshadows the next closest competitors. We're talking China at $17.7 trillion and Japan at $8.7 trillion. American equities are, without a doubt, the undisputed heavyweight champions of global finance right now. No contest. And this brings us to a metric famously known as the Buffett indicator. It's just a simple ratio comparing total stock market cap to the country's GDP. Well, right now it's sitting at a pretty extreme 262.6% for the US. Think about that for a second. That means the stock market is currently valued at over 2.5 times the size of the actual American economy. We are pushing well into the extreme valuation range here, folks. Moving on to Section 2, the Great Narrowing. You see, historically, the S&P 500 was viewed as this beautifully balanced cross-section of the U.S. economy. Back in 1990, the top 10 companies made up about 19% of the index. Even at the absolute peak of the dot-com bubble back in 2000, it only reached 27%. But get this, by 2025, the weight of the top 10 companies practically doubled from a decade prior, surging to a historic 41%. That is massive. Analysts over at RBC Wealth Management have actually coined this phenomenon the Great Narrowing. And it makes sense. It's almost like an upside-down pyramid, right? A rapidly shrinking number of tech and AI megacaps are essentially consuming the vast majority of the market space. They're literally pushing out the traditional industrial, consumer, and energy giants that used to share the spotlight. So what does this actually mean for performance? Well, over a recent 3-year period, there was a staggering 32% performance gap between the regular market cap weighted index, which, remember, is heavily skewed by those AI giants, and the equal weighted index, which just treats all 500 companies the same. That outperformance gap is actually larger than the extremes we saw during the dot-com bubble. Crazy, right? And it leaves the cap-weighted index trading at a massive 30% premium.
Okay, Section 3, the AI heavyweights. Now here is where the disconnect really begins to show. The top 10 stocks now represent roughly 41% of the index's total weight, as we just saw. But wait for it, they only generate about 32% of its actual earnings, so their market value is accelerating way, way faster than their actual profit contribution to the index. But listen, these companies aren't just standing around enjoying the view. Data from Apollo shows that the ratio of capital expenditures, the money spent on buying, maintaining, or improving fixed assets, compared to earnings for the largest AI firms, is sitting at around 0.36. That is more than double the ratio for the rest of the S&P 100. They are just pouring cash right back into infrastructure.
In fact, if you look at the hyperscalers, we're talking giants like Amazon, Google, Microsoft, Meta, their capital expenditures as a share of net sales is rapidly approaching a massive 22%. They're building the data centers, they're buying up the chips that'll power the AI revolution. They're betting heavily that all this infrastructure is going to pay off big time down the road.
Section 4, the valuation disconnect. Now this is just a staggering figure. The average price-to-earnings ratio, the PE ratio, of the top 10 companies in the S&P 500 has pushed all the way up to 50. Let that sink in. Investors are literally willing to pay $50 for every $1 of earnings these specific companies generate, and it's fueled almost entirely by the promise of AI dominance.
And as you might guess, it's lifting the whole boat. Even when you look at the entire S&P 500, the PE ratio sits at 21.61. Now, according to historical pendulum indicators, this places the entire market firmly in the overvalued zone.
sitting roughly 24% away from its historical mean reversion space. And look, whenever the pendulum swings this far into optimism, history tells us it eventually snaps back.
Now, to be completely fair here, these aren't the empty shell companies we saw back in the late 90s dot-com boom. Not at all. These AI leaders boast incredible margins, really strong balance sheets, and they have real cash flow. But as RBC Wealth Management clearly points out, their market value concentration has definitively run ahead of their fundamental profitability.
Which brings us to Section 5, Risks and Investor Strategies.
So what's the major hidden risk here? Well, experts are calling it the passive concentration trap. Think about it. Millions of everyday investors buy a standard S&P 500 index fund, thinking, hey, I'm getting a safely diversified basket of 500 companies. But in reality, more than $40 out of every $100 they invest flows straight into just 10 tech companies. This ties your portfolio's fate almost entirely to the success of AI adoption.
And that introduces what we call idiosyncratic shock risk. Think of the market kind of like this towering bridge. If an earnings miss hits just one giant load-bearing pillar, say NVIDIA, which alone accounts for nearly 8% of the entire index, the whole structure of the market's going to feel it. I mean, a hiccup in one single company shouldn't rock a 500-company index, right? But today, it absolutely does. So how do you survive this top-heavy environment? Strategists at Oppenheimer recommend a specific playbook. They persist in favoring GARP, which stands for Growth at a Reasonable Price. Basically, instead of chasing these overvalued tech stocks, they suggest actively diversifying into resilient cyclical sectors. Think industrials and financials. You basically have to intentionally build back the balance that the index itself has lost. As we wrap up this explainer, you really need to take a close look at your own holdings, especially those quote-unquote safe passive index funds. And you have to ask yourself this one vital question. Is your nicely diversified portfolio actually just a massive concentrated bet on AI?